Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 7 of what is now going to be my 8-part video series on Roth IRA conversions. In this video, we're going to kick off our Q4 tax planning conversation with a continued look at our cash flow generating assets. Starting with topic number 1, we're going to look at qualified and non-qualified dividend paying securities and how we can begin to think about these investments in the context of planning for Roth IRA conversions. Topic number 2, we're going to move to taxable versus non-taxable interest income streams and what we should be considering in the context of maximizing the after-tax cash flow in our fixed income portfolios. Topic number 3, we're going to take a high-level look at the tax law in the United States as well as some family tax planning strategies that could help maximize your Roth IRA conversion potential. Finally, in topic number 4, we're going to look at the fundamental concepts of the Roth IRA vehicle as well as Schedule C income and how we can consider these topics in conjunction with our overall tax planning strategies and opportunities. With that said, let's jump in. And by the way, if you enjoy this video, please like and subscribe and let me know in the comments what's going on in your personal tax planning situation. All right, we're going to start today's video by looking at a 1099 div. Now here is a 1099 div right here that is part of a 1099 consolidated. And a 1099 consolidated is the form you will typically receive from all of your brokers after the year is up. 1099 consolidated just means that it takes a bunch of other 1099s like 1099 div, 1099 INT for interest and so forth, and it basically just compiles them all into one schedule. Now over here I have a standalone 1099 div, so this is just a separate form that you would receive with dividend information on it. But at the end of the day, this little section of a 1099 consolidated and this standalone form over here are all providing the same information. And what we want to focus on today is going to be box 1A and box 1B. And you can see the same thing over here. Box 1A says total ordinary dividends and box 1B says qualified dividends. Now, what do box 1A and box 1B represent? So box 1A is going to be the total dividends that you actually receive in cash. And box 1B is the portion of box 1A that receives special tax treatment, i.e. the 15% rate. So how are box 1A and box 1B taxed? Well, box 1B is taxed at the special 15% rate for capital gain and qualified dividends, except in the case where you may have really low or high income that would either push you down into the 0% or up into the 20% rates for capital gain and qualified dividends. But in general, for most people, it's going to be the 15% rate that applies. And then box 1A minus box 1B is taxed at your marginal rate. So let's look at these 5 scenarios and ask the question, is this possible? Scenario number 1, box 1A has $30,000 in it, box 1B has $0 in it. Is this possible? And the answer is yes. This would mean that your qualified dividend percentage is 0%. In other words, your qualified dividends are 0% of this amount right here. Scenario number 2, box 1A has $30,000 in it, box 1B has $9,000 in it. Is this possible? And the answer is yes. This means that your qualified dividend percentage is 30%. In other words, 30% of 30,000 is in box 1B, 9,000. Scenario number 3, box 1A has $30,000 in it, box 1B has $27,000 in it. Is this possible? And the answer is yes. This means that your qualified dividend percentage is 90%. In other words, 90% of this total of 30,000 is qualified dividends being taxed at the preferential rates. All right, scenario number 4, box 1A has $30,000 in it, box 1B has $30,000 in it. Is this possible? Yes, this would mean that your qualified dividend percentage is 100%. In other words, you received $30,000 in cash dividends and the entire amount is subject to the preferential rate. And then finally, scenario number 5, box 1A has $30,000 in it, box 1B has $35,000 in it. Is this possible? And the answer is no. Box 1B can never be more than box 1A. Remember what we said right up here. Box 1B is just a portion of box 1A. Box 1B 1B can never be more than what's in box 1A. Box 1B could be none of the amount in box 1A. Box 1B could be the entire amount in box 1A. Box 1B can be any amount between 0 and the amount in box 1A, but box 1B can never be more than box 1A. If you ever were to see something like this, which is highly unlikely, you want to get on the horn with your broker and tell them, hey, there's a mistake on this form, and they will send you a revised copy of the 1099, and it will have this box right here checked. That means this is a corrected version of the same form, because there's no way that box 1B was going to be more than box 1A. Now let's look at two families and analyze their 1099 div information. So over here we have the Barney family, and then here we have the McFly family. Now the Barney family has W-2 income of $230,000. They have a 1099 div box 1A with $30,000 in it, and they have a 1099 div box 1B with $9,000 in it. Over here, the McFly family is also working with W-2 income of $230,000. They have a 1099 div box 1A also with $30,000 in it, and they have a 1099 div box 1B with $27,000 in it. All right, let's do our taxable income calculation starting with the Barney family. So we have the W-2 wages of $230,000. We have the ordinary dividends from box 1A of the $30,000. Now we have to back out the qualified dividends from box 1B of $9,000, because remember, right now we're calculating ordinary taxable income subject to your ordinary income tax rates. And what did we say before? We said that box 1B was subject to the preferential tax rate, and box 1B is just a portion or subset of box 1A. So the amount of dividends actually subject to the ordinary income tax rates is going to be box 1A minus box 1B, as we said before. Then we have the standard deduction of $29,200 for married filing joint. We're going to assume this is a 2023 tax return, and that results in ordinary taxable income of $221,800. Now right down here we're going to have a section for special treatment income. In this case we have the qualified dividends of $9,000. So in order to get the grand total taxable income for the Barney family, we're going to take the $221,800, we're going to add $9,000 to it, and we're going to have $230,800. All right, next let's do the tax calculation for the Barney family. So we're going to go to our ordinary income tax brackets, and as you recall, the first $22,000 is taxed at 10%, resulting in $2,200 of tax. In the next bracket we have $89,450 minus $22,000 multiplied by 12% gives us $8,094. Let me double click on that and you can see it's this number minus this number multiplied by the percentage applicable to that bracket. Same thing in the next bracket. We have the $197,50 minus the $89,450 multiplied by 22%. Let me click on that and you can see it's this number minus this number right here multiplied by the rate applicable to that bracket. And then finally in the 24% bracket, what are we going to do for this calculation right here? Is it going to involve this number? No, because we have not reached this level of taxable income yet. In our situation, we are at $221,800 of ordinary taxable income. So this tax right here is calculated as the $221,800 minus the top of the previous bracket multiplied by the rate applicable to this bracket, giving us $7,452 of tax in that bracket. So the grand total ordinary income tax for the Barney family in this situation is $40,032. Then we have to add in the tax for the special treatment income, which as you recall is $9,000 of qualified dividends multiplied by the 15% rate gives us $1,350 of tax. Then we have our net investment income tax, which we've talked about before in the series. Remember, that's 3.8% of net investment income if total income exceeds $250,000. So how do we calculate that number? Well, right here in this cell, we have the sum of D52 to D53, which is going to be our income items right up here, $230,000 plus $30,000. So that $260,000 total minus the $250,000 threshold results in $10,000. And when that's multiplied by the 3.8%, we end up with $380 of net investment income tax. So the grand total tax for the Barney family in this situation is going to be the $40,032 of ordinary income tax plus the $1,350 of the tax on the qualified dividends, plus $380 of net investment income tax, resulting in $41,762 of total tax. Now, before we move on to the McFly family, I want to drop the Barney family's numbers into TurboTax. So let's walk through this. So here's the $230,000 of W-2 wages, which we have right over here. Here's the $30,000 of ordinary dividends, and then there's the $9,000 of qualified dividends being backed out right here. And that agrees to our $30,000 right here, plus our $9,000 being backed out right there. Here's our standard deduction of $29,200 right here, which agrees to this number right there. And as you recall, the $221,800 here, plus the $9,000 of qualified dividends is going to give us total taxable income of $230,800, which agrees to line 15 right here on our 1040. Then down in the tax calculation, we have $41,382 right here, which is going to be the sum of this $40,032 plus this $1,350. There's our $380 of net investment income tax right there, resulting in a grand total of $41,762 here, which agrees to our calculation $41,762. All right, next we're going to do our taxable income calculation for the McFly family, and we're going to go through this one a little bit quicker because so far we've only put in one difference between the McFly family and the Barney family. So we have the $230,000 of W-2 wages, that's the same. We have the $30,000 of ordinary dividends, that's the same. This time, however, we have $27,000 of qualified dividends being backed out right here. As I mentioned, this is the only thing so far that is different between the Barney family and the McFly family is the qualified dividends. There's our standard deduction of $29,200, resulting in ordinary taxable income of $203,800. To that number, we will add the separately stated $27,000 of qualified dividends right here, resulting in total taxable income of $230,800. And as you probably noticed, total taxable income remains the same as with our example using the Barney family. Now, if you're still like, wait a minute, how can this be the same as the Barney family when we have $27,000 now in qualified dividends? If you were thinking that, then you have to think all the way back to the beginning of this presentation and remember that this $27,000 is only a subset of this $30,000. It's not extra, it's not more, it's just part of this. It's just the part of the $30,000 that gets a special tax treatment. So we take it out of the $30,000 right here, but then we put it back in right here. So because we take the number out here and we put the number back in right here, then it doesn't matter what the number is. The total taxable income will be the same, although the tax calculation itself will change a little bit, as we will see in just a moment. All right, next let's do our tax calculation for the McFly family. So the results in the first three brackets right here are going to be identical to the Barney family. So we already went over how those were calculated. Now what about the 24% bracket? Well, again, that's going to be this $203,800 of ordinary taxable income minus the top of the previous bracket multiplied by the rate applicable to this bracket. So if I double click on that, you can see it's cell D103, which is this one right here, minus the top of the bracket times 24% gives us the $3,132 right there. So the tax results for the McFly family are $35,712 of ordinary income tax. This time we have $4,050 of tax on the qualified dividends because those are now $27,000. Our net investment income tax remains the same at $380 because net investment income tax has nothing to do with whether dividends are qualified or not. It only has to do with whether you have investment income at all. In this case, we have $30,000 of dividends, which is the investment income relevant to this example for both the Barney family and the McFly family. And we also know that total taxable income remains the same between both families. Total taxable income, as we just went over, is not affected by whether dividends are qualified or not. So in this case, the grand total tax for the McFly family is going to be $40,142. Now let's drop the numbers for the McFly family into TurboTax so we have some items to compare coming up in just a moment. So there's our $230,000 of the W-2 wages. There's our $30,000 of dividends, of which $27,000 is qualified. There's our standard deduction of $29,200, no change there. There's our taxable income of $230,800, which agrees to this number right here, $230,800. $230,800. And then here's our tax calculation. Again, this $39,762 is going to be the sum of this $35,712 right here, as well as the $4,050. Net investment income tax remains the same at $380 like we talked about, resulting in total tax of $40,142, which agrees to our $40,142 right here. So in summary, the results of the above comparisons so far are that the Barney family paid $41,762 of total tax, and the McFly family paid $40,142 of total tax. Now, the McFly family is looking at this situation, and they realize that because they had rebalanced their investment portfolio to contain a higher percentage of qualified dividends relative to the Barney family, they now have an opportunity to get some Roth conversion done and not pay any more total tax than the Barney family is paying, even though the Barney family isn't doing any Roth IRA conversion. So the McFly family decides to do a Roth conversion of $5,828 for this year, and they drop the conversion into their return. Now let's compare the tax results that the McFly family is getting while doing some Roth conversion to what the Barney family is getting without doing any Roth conversion. So on this side, we're going to have the McFly family with Roth conversion in the return, and on this side, we're going to have the Barney family original calculation, no Roth conversion in the return. Now, normally I don't bring your attention to the amount of refund because that's just going to be based on how much money was paid in estimated taxes or withholding. So the actual dollar amount right here is not really relevant or the point of me highlighting this. The point is to show equivalence. I want you to see equivalence between what the McFly family is doing here and what the Barney family is doing over here. So let's walk through this. We have the $230,000 of W-2 wages. That's the same between both families. We have the $30,000 of total dividends right here, which is the same between both families. The Barney family has the $9,000 of qualified dividends, and the McFly family has the $27,000 of qualified dividends. All that's the same as before. But now what the McFly family has done is they've determined they can do a $5,828 Roth conversion right here and ultimately get to the same tax answer as the Barney family. So after dropping this Roth IRA conversion in here, which the Barney family is not doing here on line 4B, we get all the way down to line 24 and see that the McFly family is looking at $41,762 of tax, and the Barney family is looking at $41,762 of tax. Now let's assume that this scenario repeats annually over the course of 10 years, and let's hold things like the standard deduction and the tax brackets constant over that period so we can focus on the concept and make the math easy. In that case, both the McFly family and the Barney family pay exactly the same amount of tax over 10 years. But the McFly family got $5,828 times 10, or $58,280 of Roth conversion completed for the same tax cost as what the Barney family was paying. Meanwhile, the Barney family is potentially looking at another $58,280 still sitting in their traditional IRA, possibly when arriving in their RMD years, that they then have to deal with. And so a key concept I'd like for you to take away from this example is the tax planning perspective that tax is kind of like any expense in your life. It's not just the raw number of the expense that matters, it's what you get. And you deal with this every day on every transaction throughout all of your financial affairs. It's not just the raw price, it's what you get. Take a car, for example. If price was the only consideration, then only the cheapest car would ever sell, right? So why does every other car sell? Because obviously price is not the only consideration. It's the horsepower, it's the prestige, and it's everything in between those things. It's what you get. Both the Barney family and the McFly family paid the exact same amount of tax in the above example, but the McFly family got more. They got more bang for their tax buck, so to speak. Both families got $30,000 in cash dividends, but because the McFly family had set up their portfolio such that it had a greater percentage of qualified dividends in it, they were able to squeeze in a Roth IRA conversion that the Barney family wasn't able to get for the same tax cost, and so they got more. And so the perspective that you might consider adding to your tax planning arsenal is that getting more for the same tax dollars is the same thing as paying less tax. People say, I want to pay less tax all the time, but that's not really what they mean, is it? I mean, if you really don't want to pay any tax, just don't make any money. Then you'll never pay a dime in tax. So that's not what people really mean, even though it's the words they tend to use. What they really mean is I want to maximize my after-tax return or after-tax cash flow. So if you're looking at your 1099 div or your 1099 consolidated from your broker and you're seeing a low percentage of qualified dividends, and I see this all the time, by the way, I see everything from 100% non-qualified to 100% qualified and everything in between. Financial advisors have their clients all over the place when it comes to non-qualified versus qualified. So if you're seeing a low percentage of qualified on your 1099, let's just say you're in portfolio A, I'm going to call it right here. Here's the question you might consider asking your financial advisor. Is there another portfolio with 1, an equivalent risk profile, and 2, with equivalent investment objectives or return on investment expectations that you might be able to consider, but the one big difference could be that it pays a larger percentage of qualified dividends? For example, if portfolio A and portfolio B above have risk profiles and investment objectives that are roughly equivalent, I think there would need to be a compelling reason to be in portfolio A versus portfolio B. And maybe your financial advisor has that compelling reason, and if they do, that's great. And if after the discussion you both agree to stick with portfolio A, that's fine. But at least you took the time to ask the question and you made a decision from a place of being informed instead of just being in portfolio A because you never even thought to ask about it before. And if your financial advisor is like, well, I have like 10 portfolios and I kind of just have to put some of my clients in each one, wink wink, you know what I mean, like so I can meet my metrics, well, I'm sure they're not doing that, okay? That's just something for old movies. But in all seriousness, I think you would be remiss not to at least ask if you're seeing a low percentage of qualified dividends. And with that, let's move to taxable versus non-taxable income streams. All right, next up, let's talk about municipal bond income. Now, what is that? Well, it's the interest income that is generated from bonds issued by state and local governments, school districts, sometimes like special utility districts or zones that are state and local government related, stuff like that. These entities issue bonds to raise money for various purposes, and the interest paid on those bonds is called municipal income. Now, municipal income is tax-free for federal, and that's by statute, i.e. by law, where Congress has just decided, yeah, we're just not going to tax that. In other words, the taxability is not based on anything specific to you. It's not based on your facts and circumstances or income thresholds or anything like that. It's just tax-free for everybody. So municipal income is a tax-free income stream that could potentially be included in the fixed income portion of your portfolio. By the way, whether or not municipal income is taxable for state purposes is going to vary by state. A common scenario is something like this. Let's say that you are a resident of state A and you receive muni bond income from bonds issued by the government of state A. This in-state source muni income may not be taxable to residents of state A. On the other hand, let's say you're a resident of state A and you receive muni bond income from bonds issued by the government of state B. A lot of times this out-of-state source muni income may actually be taxable to residents of state A. Now, don't quote me on this scenario for any particular state. It is your job to look this up on a state-by-state basis if this applies to you. I would just Google something like Oklahoma state source municipal income taxability in, and then just insert a state right here. You could put Oklahoma, and therefore you'd be checking to see if in-state source municipal income is taxable in Oklahoma. Or you could put another state here and see if Oklahoma source municipal income is taxable in some other state. For our purposes, we're going to focus on the elephant in the room, which is federal. So let's say that we have two bond portfolios. Your financial advisor could certainly have you in some fixed income like this, or you could be investing in these yourself, or you could even be in bond funds, which are basically like a basket of various bonds. So for our example, let's say that portfolio 1 contains only corporate bonds, and the interest income coming off corporate bonds is taxable, just like the interest income off almost anything is taxable, except of course for municipal income. Then over here in portfolio 2, we're going to have exclusively municipal bonds. Now for this example, we're going to assume that default risk is equivalent between these two portfolios. There are two kinds of risk when it comes to investing in bonds. One would be default risk, and that's the risk that the issuer of the bond, whether it be a company or a municipality, won't pay you at the end when the bond matures. So we're going to assume that these are your high-grade bonds, these are your blue-chip companies, you're not worried about default, so the default risk here is low or negligible. And we're going to assume the same thing over here, that these municipalities are not going to default, you're not really worried about that, default risk is low. But even more importantly than the amount of risk is that we're going to assume these are equivalent, okay? So we're going to eliminate default risk from the picture by just setting them equal across the two portfolios for this example. So we have equivalent default risk. Now we're also going to assume that there is no market risk in these investments because you are planning to hold until maturity. There can only be market risk in a bond investment if you need a market within which to liquidate the investment prior to maturity. If you're planning to hold till maturity, then there's no market risk because you don't need to liquidate anything. You're holding until the issuer of the bond returns the money at the end. So the only remaining risk, if there's no market risk, the only remaining risk would be default risk, and we're setting that equal between the two portfolios. So in summary, these two fixed income portfolios are of equivalent risk for this example. Okay, so we're going to do a pop quiz. If these two portfolios are of equivalent risk, which one has to pay a higher rate of return? I see one hand in the back. And the answer is this one right here, portfolio number 1 with the corporate bonds in it. This one has to pay a higher rate of return if these two portfolios are of equivalent risk. Now, why is that? Well, this one over here, the corporate bonds, is a taxable income stream. And this one over here, the municipal bonds, is a non-taxable income stream. So let's just assume for a minute that they paid the same rate of return. Let's just say that they pay 5% each rate of return. If that's the case, why would anybody invest in a 5% rate of return taxable income stream when you could get a 5% rate of return non-taxable income stream for the same risk? And the answer is that you wouldn't. I mean, there's always that one guy, right? But in general, you wouldn't. The rational investor wouldn't because it doesn't make any sense to do that. So it's not a law that corporate bonds have to pay a higher rate of return. It's not a rule. It's market forces. The invisible hand of the market will cause investment to move toward the municipal income stream if both portfolios pay the same rate of return and are of equivalent risk, which is what we're assuming in this example. In other words, in order to compete for investment, a taxable income stream will have to pay a higher rate of return, assuming equivalent risk with a non-taxable income stream. So now we know that the corporate bonds, i.e. the taxable income stream, has to pay a higher rate of return. So with that in mind, let's say that portfolio 1 with the corporate bonds is paying a 6.5% rate of return, and portfolio 2 over here with the municipal bonds is paying a 5% rate of return. Now in that case, which portfolio is a better investment? And remember, the risk is the same. We have set that equal between the two portfolios. So the question really is, what's better, a 6.5% taxable income stream or a 5% non-taxable income stream? Well, that's going to depend on your tax rate, isn't it? But I know I got at least one person right there. Come on, fess up. That one's better. Nope, we don't say that here. We don't say that. Neither one is better. It's only better or worse based on your tax rate, based on your facts and circumstances. Let's crunch the numbers. All right, let's analyze these side by side. So here's our corporate bond portfolio. That's our taxable income stream. Here's our municipal bond portfolio. That's our non-taxable income stream. So let's just say we have $500,000 allocated to each one of these. This one has a rate of return of 6.5% as we discussed, and this one has a rate of return of 5%. That means the income generated for the year off the corporate bond portfolio would be $32,500, and the income generated over here on the municipal bond portfolio is $25,000. Now for this example, let's assume we're in a low tax rate. Let's say the 12% tax rate. That would result in $3,900 of tax on this $32,500 of income. Of course, over here, this is a non-taxable item, so there's no tax rate and there's no tax applicable. So now when we take the $32,500 of interest income and we subtract off the $3,900 of associated tax, we get an after-tax return of $28,600. Meanwhile, over here, we're still at $25,000 of after-tax return on the muni bond portfolio. So as you can see, in this fact pattern right here, when we have a tax rate that is on the lower end of the range, it turns out that the taxable income stream actually produces a greater after-tax return relative to the non-taxable income stream. Now, what about if the tax rate is higher? So in this example, we're going to keep everything the same except for the tax rate. So we have the same $500,000 invested in both portfolios. This one still pays a 6.5% rate of return. This one still pays a 5% rate of return. We're still looking at $32,500 of interest income before tax here and $25,000 of interest income over here. However, now, assuming that we're in a higher marginal tax rate, let's just assume 32% for this example, we're going to have tax of $10,400 on this interest income. So when I take the $32,500 of pre-tax interest income and I subtract off the associated $10,400 of tax, we now end up with an after-tax return of $22,100 on the taxable income stream and $25,000 on the non-taxable income stream. And so the muni bond portfolio ultimately produces a greater after-tax return in the case where our tax rate is higher. And this makes sense because something that is tax-free is worth more the higher your tax rate goes, right? I mean, if your tax rate is low, then tax-free just doesn't mean as much. Like, here's an extreme example to drive home the point. Let's say your tax rate happens to be 0.00001% and somebody comes to you and is like, hey buddy, I can get you a tax-free return. It's like, who cares? You know what I mean? So the point is that tax-free means more the higher your tax rate. So for example, let's say you go to your financial advisor in a year when you're in a high tax rate and they're like, I got you completely out of muni. We went overweight on corporate bonds in your portfolio. Well, you might be like, well, wait a minute. I'm in like the highest tax brackets here. What do you mean you got me completely out of muni? On the other hand, if you're in the lower brackets and your financial advisor has got you overweight in muni, you could be getting dinged there with a lower after-tax return on investment, as we just demonstrated. So again, it all depends on your tax rate. And just to be completely clear, it's going to be based on your tax rate in combination with the spread between the rate of return on the non-taxable income stream and the rate of return on the taxable income stream, right? We have 150 basis point spread right here between these two income streams. That's what finance people like to say. They like to use the phrase basis point. Okay, so this is 150 basis points right here, or 1.5%. The point is that obviously the spread here will have some impact on the ultimate results you get down here. So it's a combination of your tax rate and then the spread between these two investments. And so you want to understand that so you can make the most informed decisions possible when it comes to your fixed income investment portfolios and maximizing your after-tax rate of return. Now, with that said, let's talk about some family financial planning matters. Actually, before we get to the family financial planning conversation, let's take a quick high-level look at the tax law in the United States, starting with this car, for example. Is this car deductible? Well, what are you doing with it? Let's make a little diagram here. So I'm cruising on Sunday afternoons and I'm using the car to commute to a W-2 position. In that case, then no, the car is not deductible at all. You cannot deduct the cost of the car itself and you cannot deduct any costs associated with operating the car. Okay, next, it's my personal car, but I'm also using it partially for business to go around and to see customers and clients. Okay, in that case, it is partially deductible over time. You can deduct part of the cost of the vehicle itself over time, and you can deduct part of the costs associated with operating the vehicle. Okay, now I purchased the car in my business name, and I use it 100% of the time for business to go around and see customers or clients. Okay, in that case, then it would be fully deductible over time. You'd be able to deduct the full cost of the vehicle over time, and you would be able to deduct costs associated with operating the vehicle. Okay, now the car is purchased in my business name, but the car isn't used for transportation. Rather, the car is the business in some way. And examples of this could be anything from the car is being used in professional racing to the car is being used as a showpiece or a review piece or a display piece or a demonstration piece in some way, or you have some kind of business where you review and test drive vehicles or you parts them out. There could be all kinds of possibilities that fall into this category of, yes, the car is part of my business, but it's not just being used as transportation to go around on a day-to-day basis. In a situation like that, the car would most likely be fully deductible, and it could be over time or it could be immediately, and it will be heavily dependent on the facts and circumstances of this particular situation right here. And finally, I'm an auto dealer. The buying and selling of cars is the business. In my hands, the car is inventory. And in that case, the cost of the vehicle will be fully deductible immediately upon the sale of the vehicle to a customer. You will not have to spread out the deductibility of that vehicle over time. So what I want you to see is that as we move from this side of the tax law over here to this side of the tax law over here, the benefits become more favorable. We go from not deductible at all to partially deductible to fully deductible, and we go from deductible slowly over time to deductible right away. To make this even more general, let's set it up like this. The tax law in the United States is, number one, least favorable to the individual. And this is always the way it is right here. Tax law is least favorable to the individual. Just like we can see in this diagram, when your facts and circumstances are operating in this part of the tax law, this is where you will discover that the benefits are the least favorable. Now, number two, as we move over here, we will find that the tax law is more favorable to the family unit, and then the tax law is more favorable to business enterprise. Now, how is it more favorable to the family unit? Well, let's say that historically, all of your financial facts and circumstances were operating in this part of the tax law over here that we just determined was the least favorable. This, by the way, is the same chart that we were just looking at on the previous page. But then one day you decide, you know what, I want to take advantage of some of the additional benefits available to me and my family under the tax law. So you move a little bit of your financial facts and circumstances over here into this part of the tax law right here. So now you have some of your financial affairs going on here in this part of the tax law, and you have some of your financial affairs going on over here in this part of the tax law. And in order to be over here in this part of the tax law, you start a simple Schedule C business, and let's say that after it gets up and running, you're bringing in $75,000 a year on average. Nothing too extreme, just a modest small business. Now, things are going smoothly, but just as in any business, you discover that there's this one routine task which you just find really boring. It's got to be done. It's important to the business, but you're like, you know, I really wish I could just outsource this task or otherwise find somebody to do it. It's just boring. I'm tired of doing it. And as you're thinking that, you look over into the living room and you see little Johnny sitting over there on the couch. He's 12. And then next to him is little Susie. She's 14. And you get this idea. You say, you know what I'm gonna do? I'm going to hire my own kids, or grandkids, works the same way, and they're gonna work for me part-time, 5 hours a week, and they're gonna do this task that I don't wanna do. I mean, to me, it's boring, but to them, it's something new, at least for a while. And I'm gonna pay them like employees. They're gonna learn some professional skills, they're gonna learn about responsibility, they're gonna learn about the value of a smart day's work, they're gonna make a few bucks, and so on. It'll be good for them. I mean, like, as opposed to what? Well, like, I don't know. I mean, they could be sitting around, playing with the, what's that called again? The Angry Birds. Ever seen them? What you do is you take a cartoon bird and you shoot it out of a slingshot into a wall. So, they could be doing that, right? I mean, that's certainly something you could be spending your time doing. Or, they could be learning a few business skills, learning a little bit about money, stuff like that. I mean, you hear it all the time, right? They don't teach those kids nothing about finance and money in school. Yeah, well, now's your chance, isn't it? Now's your chance to teach them a little something about finance and money. And to do so from within the safety of the family unit. Okay, so you do that. You hire your own kids or grandkids to work part-time in your Schedule C business. And let's say you do that for 1 year, and during the course of that year, you pay each of them, I'm just gonna make up a number, $13,850. Okay, now tax time comes around, as it always does, and this year, little Johnny and little Susie both have earned income. They even have W-2s. I mean, they're employees, right? So they're each going to have to file a tax return, and great, they can learn a little something about that too. So they break out their 1040s and they drop their $13,850 right up there on line 1. Here it is right here. Wage income for little Johnny, $13,850, and wage income for little Susie, also $13,850. Now, what's their filing status? Well, it's going to be single, right? A minor is going to be a single filer. That should be pretty straightforward. Okay, so what's the standard deduction for a single filer? Let's assume this is a 2023 tax return. The standard deduction is $13,850. Oh, that's handy. So here's little Johnny's return. He's got his wage income of $13,850 right there. He drops in the standard deduction of $13,850, and he's got taxable income of 0. Over here for little Susie, exact same thing, taxable income of 0. So both little Johnny and little Susie are in the 0% tax bracket, basically. Now let's take a look at mom and dad, or grandma, grandpa, either way. Let's assume that all your other income items put you in the 24% bracket. So your marginal rate is 24%, and that's the rate that your Schedule C business income will be taxed at. So before hiring little Johnny and little Susie as employees, your tax calculation with respect to the Schedule C business income would be as follows. So here's your Schedule C family business. You got your business income of $75,000. You're already at the marginal rate of 24% due to all your other income. So your income tax specific to this business is $18,000. And in this situation then, the after-tax cash flow within the family unit from this Schedule C business is $75,000 of income minus your $18,000 of tax leaves $57,000 of after-tax cash flow. But now, after hiring little Johnny and little Susie, you gotta pay salary, and you're looking at $13,850 times 2 is $27,700. So we're gonna redo our Schedule C family business calculation. So here's the income before the salary expense, which is the same as before at $75,000. Here's the new salary expense of $27,700. That results in revised business income in this situation of $47,300 multiplied by your marginal rate of 24% results in $11,352 of tax. So now let's do an after-tax cash flow comparison for this Schedule C business. And remember, we're looking at the family unit as a whole. So at mom and dad or grandma and grandpa's level, we have the business income of the $47,300 right here. Now we take away the new calculated amount of tax tax of $11,352, resulting in after-tax cash flow specific to this Schedule C business of $35,948. But now we also have to add in the cash that's being held by little Johnny and little Susie. So little Johnny's working with $13,850 and little Susie is working with $13,850 of after-tax cash flow. So when we add up the $35,948 plus the $13,850 plus another $13,850, we end up with $63,648 of after-tax cash flow in this revised scenario. And then when we compare the two scenarios based on after-tax cash flow, in the second scenario we had $63,648 and in the first scenario we had $57,000, resulting in additional cash retained within the family unit of $6,648. So under this fact pattern, you were able to keep an additional $6,648 of cash within the family unit and out of the hands of the government. And you did this by, let's think about our brackets right now. You did this by shifting $27,700 out of the 24% tax bracket, which is what mom and dad, grandma and grandpa were subject to in this situation, and into the 0% tax bracket. Okay, so here's the 24% bracket. Over here, you took $27,700 and you shifted that over here into the 0% tax bracket. This is a permanent tax savings within the family unit. And the same concept applies if it's grandma or grandpa running the Schedule C business. You'd be shifting income out of this bracket right here and into the 0% bracket over here with the grandkids. Now the kids need to be bona fide employees of the Schedule C business. They need to be providing services to the business that the business legitimately needs. But that's a pretty easy standard to meet in most cases. There are plenty of simple and routine tasks involved in any family business where a part-time employee new to the workforce, so to speak, can provide value. Now we can also look at this situation with the same tax planning perspective that we established earlier when we were discussing qualified versus non-qualified dividends, which was that getting more for the same tax burden is the same thing as paying less tax. For example, in this case, we could do a Roth conversion equal to the $27,700 we paid the kids for the part-time work. But actually, we can do even better than that. Let's crunch the numbers. And as we get to the number crunching, I want you to remember these three figures right here. $75,000 was the original income before we started paying the kids. $27,700 was the amount that we actually paid the kids. That resulted in $47,300 after the salary expense. All right, so let's go through these returns. So on the left side, we're going to have the before hiring your own kids or grandkids scenario here. And on the right side, we're going to have the after hiring your own kids or grandkids here. So we're going to keep the $230,000 of W-2 wages equivalent between the two returns, just like we had in some of the previous examples. Now, right down here on the left side, here is the $75,000 of Schedule C business income before hiring the kids. And on the right side, here's the $47,300 of Schedule C income after paying the salary expense to the kids. Now, the one big difference I want to show you is that on the left side, before hiring the kids, right now we have $0 of Roth IRA conversion in the tax return. And then over here on the right side, I've put in $42,050 of Roth IRA conversion into the return. Now, if we go all the way down to line 24 here, this return on the left side is looking at $62,318 of tax right here. And on the right side, we're looking at $62,318 of tax right here. So in this fact pattern, for example, by paying the kids a total of $27,700 for 1 year of part-time work, we were able to get a $42,050 Roth IRA conversion completed for the year with the same total tax burden as before hiring the kids in the first place. Let's make sure we understand why. Now, before we start the ordinary taxable income calculation, we're going to jump right down here to the self-employment tax calculation. And the way this works is that when you have a Schedule C business, you're considered to be self-employed with respect to that business. You can still be employed at another business where you collect your W-2, and over there you would be considered an employee, but with respect to this business specifically, you would be considered self-employed. Self-employment tax is basically 15.3% of your self-employment income, and we're going to walk through that here in just a second. And then you get to deduct half of the self-employment tax up here in the ordinary taxable income calculation, and that's why we're going to go through the self-employment tax first. So the self-employment tax calculation is pretty straightforward. Here we have our business income, which as you recall was $75,000 before we hired the kids and $47,300 after we hired the kids. Now the amount of your business income subject to self-employment tax is going to be 92.35%. That's just an amount designated by law. So right here, if I just take this number up here and I multiply it by 92.35%, we're going to get the amounts in both cases that are subject to self-employment tax. Then we're going to multiply these numbers by 15.3% and we're going to get the self-employment tax right down here. Okay, now let's run through the ordinary taxable income calculation. So there's our W-2 wages of the $230,000. That's the same between both scenarios. Here we have our business income of $75,000 before we hired the kids and the $47,300 after we hired the kids. There's our Roth IRA conversion of the $42,050, which we mentioned earlier. We're not dealing with any qualified dividends in this example, so this line is just a carryover from earlier in the presentation. Okay, here's where we get to deduct 1/2 of the self-employment tax. So this number right here, this number is just 1/2 of this and this right here. Then we have our standard deduction, and we're looking at $270,501 of ordinary taxable income in the first situation and $286,808 in the second situation. Now let's jump down here to our tax calculation. We know how this works. So these brackets are the same. These brackets are the same. These brackets are the same. This one is going to be what? This number right here, the ordinary taxable income, minus the top of the previous bracket, multiplied by 24%. And the same thing over here. We have the $286,808 minus the top of this bracket, multiplied by 24%, gets us $23,054. So the result is $51,720 of ordinary income tax under scenario 1 and $55,634 of ordinary income tax under scenario 2. But when we look right down here, we get the $62,318 of total tax in both scenarios. And this number right here on this line is just going to be the sum of our self-employment tax right here plus the sum of our ordinary income tax right there. So what you can see in this fact pattern is that the increase in ordinary income tax right here is offset by the decrease in self-employment tax right here. And the reason we have an increase in the ordinary income tax in the first place is because in the original scenario we had $75,000 of business income, but now when you add up the $47,300 of business income plus the $42,050 of Roth IRA conversion, that total right there is actually $89,350, which is $14,350 more than this. And so what happened is we were able to squeeze more income through that Roth IRA conversion into the ordinary income tax part of the calculation, but it was offset by a reduction in the self-employment tax because when we paid the kids, it reduced the amount of income that was actually subject to self-employment tax from $69,263 down to $43,682. And so the combination of employing the kids with this strategy plus the interplay between the ordinary income tax rates and the self-employment tax allowed us to squeeze in a $42,000 Roth IRA conversion for ultimately the same total tax burden between the two scenarios. In addition to this, the kids now have earned income, so they can open their own Roth IRAs and fund them up to the annual limit, i.e. $7,000 in 2024. So even in the first scenario where you didn't do any Roth IRA conversion, you still retained an additional $6,648 of cash within the family unit. And now, assuming 2 kids, as in this scenario, you can get an additional $14,000 stuffed into Roth IRAs within the family unit. And with that in mind, let's ask the question, what is a Roth IRA? IRA at the most fundamental level. Let's talk about that. But before we do, I just want to summarize everything we just discussed about the family tax planning strategy above in like one sentence. You are literally just handing your family's money over to the government because you refuse to teach your kids or grandkids how to open and operate a simple business in the United States of America. When you say it like that, a lot of light bulbs just went off right there. I can see them popping off all over the country. When you say it like that. All right, next item, let's address that question we just mentioned. What is a Roth IRA at the most fundamental level? And even more generally, what does the Roth designation or Roth vehicle or Roth bucket, whatever you want to call it, what does that really mean? And let's put aside all the nuances and just focus on the big picture for a moment. Well, it means the place you can put money where money is never taxed again, as long as you meet the basic rules. So here's the question. If you could put all your money into a Roth vehicle, would you do it? Remember, you can pull your contributions. We're not talking about conversions right here, just contributions like your $7,000 annual contribution to a Roth IRA out anytime, tax-free and penalty-free. Age doesn't matter. So since you can pull the contributions out anytime without risk or penalty, then there is zero risk in putting them in the Roth IRA in the first place. So I ask again, if you could, would you put all your money into, i.e. contribute all your money to the place where money never gets taxed again? Of course you would. The answer is of course you would. Well, not me. I don't want to put all my money in a place where it's never going to get taxed again. Okay, no human being has ever said that, so please. The point is that of course you would if you could. And so why don't you? Why don't you put all your money into a Roth vehicle? And the answer is that you can't, by law, right? You can only contribute up to $7,000 in a year. All right, if you're over 50, they'll give you $1,000 more for the year. But that's it. You can't just put all your money in the place where money never gets taxed again. Congress want to give you a little taste, but not too much, okay? Not too much. It's like negotiating with the Pawn Stars on this thing. Ever seen them? Yeah, I just want to put all my money in a place where it's never going to be taxed again. $7,000 is like the best I'm going to be able to do for you today. But I'm over 50, man. Come on, you gotta cut me a little something. I'll go 1,000 more, okay? But that's it. That's 8,000 right there, tops. So it's like negotiating with these guys. But the point is that you can't, by law. Now, there's no limit on the amount of Roth IRA conversion that you can do. I mean, you still have to consider all the things we've talked about in this video series, like smoothing out income over time to minimize RMDs and not getting bumped up into the higher brackets and IRMA impact and widow's penalty and everything else. But putting all of that aside for the moment, there's no actual law limiting the amount of money you can do with a Roth conversion. You can do all of it if you want to. But there is a practical limit, isn't there? And what's the practical limit? Well, it's how much you have in the traditional IRA in the first place, right? I mean, you can't convert more than that. And if you use some of the money coming out of the traditional IRA to cover the tax on the conversion, then even less gets into the Roth vehicle. So you're limited there on how much you can get into the place where money never gets taxed again through a practical limit. Well, wait a second. I know. Okay, I'll just put more into the traditional IRA in the first place, and then I can convert without limit. But you can't, right? You can only contribute $7,000 to the traditional IRA as well. In fact, it's $7,000 total between them. For example, you could put like $3,000 into the traditional and you could put $4,000 into the Roth, but you're still limited to $7,000 total between the two vehicles for a given year. Even little little Johnny and little Susie. They're wise. They know the power of compound interest over time. They understand the benefits of getting as much into the Roth vehicle as they can. Imagine that compounding from their early teens. They're each working with 14 large right now. They want to put all their money into the Roth vehicle. Can't do it. Can't do it. Sorry, little Johnny and little Susie. It's gonna be $7,000 apiece, not a penny more. You can't just put all your money into the place where money never gets taxed again. You're just gonna have to spend the rest on video games, okay? What can I say? And so the question always becomes, how do you get more money into a Roth vehicle? How do you get more money into the place where money never gets taxed again? Well, what's one of the big themes that we've been talking about so far in this video? Tax law in the United States is more favorable to business enterprise. Okay, so you have this Schedule C business. You even have two employees, little Johnny and little Susie. Now, as the owner of a business, you are allowed to open what's called a SEP IRA. Okay, now hold on. I know. What in the world is that? A SEP IRA? Well, it's just an account. Just like if you were looking at the computer screen for your retirement accounts at your brokerage house, I bet you can't even tell the difference between them, except one says SEP IRA and the other one says some other kind of IRA. So it's just an account, just like any account, but it's the kind of account that a business owner in the United States can open. So let's look at our diagram again for the tax law in the United States. If you are operating over here in this part of the tax law right here, where the tax benefits are the least favorable, then you're looking at an IRA contribution limit in 2024 of $7,000, as we've talked about. Alternatively, if you are operating over here in this part of the tax law, where the tax benefits are more favorable, then you'd be looking at a SEP IRA contribution limit in 2024 of up to $69,000. So let's compare this. On this side of the tax law, the IRA contribution limit is $7,000 a year. But on this side of the tax law, the SEP IRA contribution limit is $69,000 a year. And I'm just going to change this from $69,000 to $70,000 just because I like when the math is easy. Okay, just to be clear, this is just for Justin's example that we're making this $70,000. The actual law is $69,000 for 2024. So if you're operating in the individual part of the tax law where the tax benefits are the least favorable, it would take you 10 years of time to contribute the same amount to the place where money never gets taxed again as someone who is operating in the business part of the tax law where the tax benefits are more favorable is able to contribute in 1 year. This person over here can contribute up to 10 times more than over here. 10 times more. That's huge. And not just once. Every year. Every year they have the ability to contribute up to 10 times more. Now I'm going to ask a question, and for this question, everybody's hand in the room is going to go up. This has never happened before on the channel. There has never been a question before where everybody's hand goes up. And there will probably never be a question again where everybody's hand goes up. But today, everybody's hand goes up. So you're looking at your retirement accounts, and I ask you, hey, wouldn't it be nice to have 10 times more? Everybody's hand just went up. In fact, I don't see a hand that isn't up. Well, yeah, I mean, of course I could use, 10 times more. Well, here you go right here. There's your IRA annual contribution limit of $7,000, and there's your SEP IRA contribution limit of $69,000. Now you got to make money. You can't think that you're just going to sit around and not make any money and then put money in here. No, you need to make money in order to put money in here, in the SEP IRA. But isn't that the point? Like, what have we been talking about on this channel this whole time? This channel ain't about growing a flower garden, you know what I mean? The way I would word it is, we're going to make money and put it in here. That's the entire point of what we're talking about. And then we're going to convert it into the place where money never gets taxed again. We're going to get a really big Roth bucket instead of all these small $7,000 buckets. And if you want to participate in that, the tax law will incentivize you to do so. Wait, how does it incentivize you? 10 times more. The potential for 10 times more to go into the place where money never gets taxed again. You know, the tax law gets a bad rap, but at the most fundamental level, the tax law is designed to incentivize our citizens to create value, to make money, to slice off their piece of the American pie, and in doing so, to help build and bolster the economy of the United States. So the question that every American can ask themselves is, do you want to adjust your facts and circumstances such that some portion of your financial affairs operates in the part of our economy and society for which the tax benefits are the most favorable? There's no right answer. It's only what you want for yourself and your family's pocketbook. All right, folks, the summer is over. We got Q4 coming around fast. Tons of things to talk about. It's going to be a busy time for Roth IRA conversions. Plus, we got the presidential and congressional elections coming up in November, and how will the outcome impact the Tax Cuts and Jobs Act, plus all of our tax planning strategies going forward. Tons of stuff to talk about there. Remember, Q4 is the last quarter to make your conversion decision for 2024. Conversions for 2024 must be completed by December the 31st, 2024. Conversions for 2025 must be completed by December 31st, 2025. You do not get the extra time between January 1st and April 15th for Roth IRA conversions. That extra time is only for contributions, not for conversions. So the barbecues and pool parties are done. It's time to dust off the old thinker, get the chlorine out of those ears, and get ready for Q4 tax planning. In preparation for that, there is now in the members area for the personal tax planning template program an 8-part video update as follows. Parts 1 and 2 are a warm-up to get you ready for Q4 tax planning. We're going to do a personal tax planning template line by line walkthrough in the first 2 videos. Then in part 3, we're going to do a deep dive into the RMD calculator and the Roth conversion tracker with heavy number crunching promised. In part 4, we're going to continue our deep dive with capital gain and qualified dividends, including side-by-side TurboTax comparisons. Then parts 5 and 6 are going to be special topics where we're going to do Schedule 1 adjustments back to back in 2 videos. Then in part 7, we're going to do a fundamentals review, brackets, rates, and standard deduction, and how it all fits together for your Tax Cuts and Jobs Act scenario planning. And then finally in part 8, we're going to do an Excel formulas walkthrough, and all of the formulas that we use inside of the personal tax planning template will be covered.